Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in, and welcome to the new year. This is our first broadcast from 2018, and thanks for tuning into the Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. And if you go to TomWilsonProperties.com, you can look up all of our podcasts we're in our fifth year now. And we have wonderful guests such as Dr. Doug Duncan and Bruce Norris and Sean O'Toole and Robert Campbell and lots of wonderful guests who share their expertise with us, and for which we are so grateful. Also, when you go on that website, TomWilsonProperties.com, you can also sign up to our weekly newsletter, and by so doing, you become a part of our client base, which gives you access to many of our commercial syndications for office buildings, industrial, neighborhood shopping centers, assisted living development, things like that, typically for $50,000 a share. So if you'd like to know more about that, please go to TomWilsonProperties.com or give us a call at 408-867-1867. We have on today a good longtime friend of ours, our personal and business accountant for many decades, Richard Smith, who's an enrolled agent, been in the business about 40 years. And he specializes in real estate. Most of his clients have a lot of real estate holdings, and he's a long-time real estate investor himself. So I always tell everyone that when you get a professional to help you out with something, make sure they've got some skin in the game and reason to have expertise of their own. He's based in Cupertino and has been for a long time. And Richard, welcome back to the program.
Thank you, Tom.
Richard, it's been a pretty dynamic year, certainly in past some months, with a lot of flurry about changing tax bill, and each administration for quite some time, I guess since '86, has talked about it and nothing's happened. So it actually happened. So I want to. There were certainly a lot of things that were proposed that made some of us investors a bit nervous. But as it turned out, we kind of came out okay. So before we dig into some of the details, and by the way, I want to let everyone know that on January 25, we are launching a brand new real estate club on commercial investing and syndications and multifamily. It's called BACOM, BACOMM. And if you go to, we're setting up a website for it, but for right now, go to TomWilsonProperties.com. First one's January 25. It'll be in Santa Clara on Great America Parkway. I forget the address. It'll be a wonderful venue. Richard will be there to talk in more detail. And we also have Rick Knopf, who's a multi-decade commercial broker and investor who will talk to us about that topic and field as well. So, Richard, if someone asked you in the elevator going across 2 or 3 floors, give me the bottom line about the tax bill, what would you tell them?
Well, we started planning a year ago. We were doing the same thing last fall, hoping we'd have a tax bill. So we've had a whole year to put up with all the activities that have come, and I read something every day about it. The biggest problem is we had a House bill that passed, then we had a Senate bill that passed, then we had a Conference Committee bill that passed, and then they made changes to that. So what started out as somewhat simple now has over 1,000 pages to it. And
well, that's something brand new on Capitol Hill. That's never happened before, something a bit more complex.
Well, when we did this in '86, that was harmful to our real estate investors because they lost a lot of their real estate losses. This one is to our positive. Thank God Mr. Trump, put some good stuff in there for us. And so, our half my clients are real estate investors. I'm an active real estate investor, and we're all better off for this bill. Now, what I tell people, because my phone went off the hook the last couple of weeks of December. I read an article that said accountants are now rock stars because everybody needs one. But the thing is that, we read 80% of the people are going to benefit from this bill. Some people are losers.
That's a pretty impressive number, 80%.
Well, the number
now, is that
we actually have a 2018 tax calculator, and we're running numbers for our clients.
All right. So this isn't just a political hearsay. From your sample data you're doing, it's what it looks like for you.
Absolutely is. We're looking at Silicon Valley investors, and their incomes are higher than other areas of the country, and so the numbers we're seeing over 300,000, 400, 500, all of them benefited. And so I'm happy.
So would you say if our high end state here benefited, would you say that the heartland of America was probably did okay too?
Again, it depends on the individual tax return. I had a client I ran the other day. She made $150,000. She has to pay $100 more in tax. Very unusual situation. I think everybody needs to look and get some education, and hopefully we can help them today. And then, come to your meetup group. We can give them more detail. But my clients are happy.
Good. Well, let's start off with, now that we've got kind of the bottom line summary. What are some of the positive things that happened for the real estate investor? Certainly, one of the positives is what didn't happen. Right? Everybody was just sure that 1031 was going to go away, and it did not. Once again, it did not go away. Right?
That's correct. The 1031 stayed just like it was, no changes. And I do a lot of 1031s, and my clients do a lot of them. That was a blessing to keep that. That was a good thing. Also,
I guess we should not. I guess we should not assume that everyone listening is familiar with that. So the 1031 exchange is the way of selling a real estate property that is a rental and exchanging it into one or more other rental properties and deferring the tax and not having to pay capital gains at the time.
That's correct.
And if you carry that to your death and your heirs pick it up at then cost basis, you basically can avoid capital gains as long as you keep that money in real estate, right? Is that a good summary?
All of those remain. The step up remained, and the 1031 remained just for real estate, and those are both fantastic. The other thing we see that helped our real estate investors is they're going to increase write-off beginning. Actually, this is kind of surprising, Tom. They backed the date up to September 15th of 2017. The new depreciation rules go into effect. So we'll be able to use some of that for the 2017 returns we're doing. But the depreciation write-off will be better and greater for our real estate investors.
So what has changed about depreciation?
Shorter life. If the 100% write-off of anything that has a life of less than 20 years, anything you do to your rental, and that's almost everything except the structure. The structure did not change, but if the life of the AC and the carpets and the drapes and the windows and all those things, if the life is less than 20 years, you get 100% of the write-off in the year you charged it or financed it or spent it the year you installed it.
In the very first year.
Correct.
Yeah, that's huge.
That's huge. I know. And it started September 15th of last year, and nobody knew that. I mean, isn't that wonderful?
Yeah, that didn't get talked about. I guess that was down in the weeds relative to what the general public was listing for, right?
Well, we're looking
at
that's how it affects our clients, and that affects them a lot.
Sure. No, that's major. Okay. What else? What
the tax rates have dropped. That's the big part of the bill for everybody. And we've got that in our newsletter. If somebody'd like a copy, the one we sent to you this morning, they can call me or email me, and we'll send them a copy of our new email that we just blasted this morning. Tax rates have dropped for everybody, and so that's
and
good.
tell them how they can reach you, your website there.
Our phone number is 408-446-5551, and my email is Richard, RICHARD, at richardsmithtax.com. We'll be glad to send out our two-page summary. There's so many summaries out there, but Tom, the problem with all the summaries, you can look at the date it was written, because was it done after the House bill, that Senate bill was compromised? So this is as of today. Okay,
good. And yours is probably has more summary in it about real estate than the average Wall Street Journal article, because that's what so many of your clients are interested in most, right?
We covered everything, because most people look at their personal return first. where most of the changes have been publicized, the loss of the California tax deduction, those kinds of things. So we cover both those. But we also put in the new tax brackets. So we've got a chart that compares your old bracket to your new bracket for income level. So you can see, everybody's rate has dropped a couple of percent except for the lowest levels, the 0%, 10%. They have not changed. But everybody else is having rate reduction. That benefits them.
Isn't there one little tiny overlap where if you're in a certain category, it might not have gone down?
Well, what we're looking for, Tom, and we have it available to us, we have 2018 tax software. We can actually run numbers for people. Now, we don't have everything in there, but we're running simple numbers like I shared with you for a lot of our clients who came in to see me at year end. They want to know how they were affected. So we've got a little 2018 tax planner, and we can run numbers for our clients. And it covers most of the situations we see, not everything. But
so you can just take the 2017 data, plug it in, and say, all right, if this had been 2018, what would it be?
Exactly. And we're going to offer that for every one of our clients during the upcoming tax season.
That's a wonderful.
When we prepare the 2017 for $49, we'll run a 2018 for you if it'll fit our mold, and we can do that for all of our clients. So we want to know, because remember that the withholdings are going to change next month, so people will be taking more money home every pay period. So, that's what you're going to see. I think people will become happier when they see that paycheck has more money in it.
Sure. It'll be wonderful, and that's a wonderful service that you're providing. What did now, as far as it benefiting the corporate, we only have a minute left in this segment, but as far as the corporations reduction in tax benefiting the general public, there are some companies that have said they're going to pass some of that on to their employees, haven't they?
Yeah, 18 of them. It's dropping from 35 to 21%, and that's a great thing. I'm very happy to see that for our corporate clients. We're pretty excited.
Yeah, that's so. When that was, I'm amazed that when the initial proposal was 20%. I thought, they'll wind up at 25, but 22 was thrown out, and they compromised at 21. That's pretty good. They came in pretty close to the original target.
Thank you.
Yeah, so that was quite good to see. Okay, Richard, we're going to take a short commercial break here, and then when we come back, we'll talk about other aspects of the tax bill other than real estate, and how it might affect your personal return, and what kind of strategies that you might consider to take advantage of the new real estate or the new tax bill. So people forget that these tax laws are mostly written for ways that you can save money. So we'll talk about that when we get back with Richard Smith here on Real Estate Radio Power Investing. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So nice to have Richard Smith back, 40-year real estate, investor and tax advisor and an accountant, and he's been mine for almost all of that whole period of time, both for personal and for business. And it's always great to have professionals on your team that are involved themselves in what is your primary area of interest. So Richard, what is there any other thing that you want to point out before we leave kind of the specific details of real estate? Anything else you want to add about it? Basically, we didn't lose anything. We didn't lose 1031. We get to depreciate most everything except the structure at a faster rate, and we have an overall lower tax rate category. So investors came out pretty good, right?
I think they did. I'm really excited, and we're going to switch some of our clients to C corps. I mean, that's obviously something we're going to do, is to get advantage of that lower rate. But they've also provided a 20% deduction for non-service sector pass-throughs, S-corps, LLCs, partnerships, and sole proprietors. We've run some examples on this for some of our realtors, And, without going through a lot of numbers, but if you're single income net under 157, married under 315 net, you get an extra 20% deduction based on your taxable income. We didn't see that coming. That's a big bonus for our self-employed people, non-service. And the National Association of Realtors, created this special deduction for realtors, and that's amazing to me. I've done 3 seminars so far for real estate officers. I've got another one scheduled. I don't think our real estate world understands how good a deal they got because of the
But if it's not supposed to be for service sector, how do they get around calling that not service?
Because they're selling inventory on the MLS, so they've carved out a special niche market for real estate. When I read that, I've been doing this 40 years, I was knocked over because they are selling inventory, which is the key explanation of non-service.
That's true. It's no different than a field sales guy selling a mainframe, right, or a server.
Isn't that fantastic? And they don't even know it, Tom. I'm so excited about sharing this with our realtors. And also the other sides. Let's talk about the good things, because the medical deduction stayed. That was going to go away. They kept it just like it was. Charitable contributions is basically the same. Actually got a little bit higher one, but that stayed the same. And one that some of my clients are excited about, they eliminated the Obamacare mandate penalty tax. That I had some people jumping up and down over that. The other one...
Why don't you explain that?
Well, the current law says you must have health insurance. If you don't have it, you're penalized. And so they removed the penalty. You don't have to.
And they actually put that on the 1040 form, didn't they, last year?
Yes, they did. Yeah. Okay, so they've eliminated that
little detail at the bottom.
You don't have to have insurance anymore. Now, I think that starts in 2019, though, Tom, as I recall. I think that they have a year to do that. The other one that caused a lot of, oh my God, I can't tell you how many letters and emails I've read about the mortgage deduction. Let's talk about it. All current mortgages, interest, are grandfathered except equity loans. And that right now, we're staring at it, and they're saying, that's not going to be deductible in the future. The other one is for new loans. Now, again, I'm talking personal residence. There's no change in rental homes. The rental homes you have today, next year will be the same. You'll get the same deductions with more depreciation, but you get the same interest, taxes, insurance, all those things. But they changed it. If you're buying a personal residence, currently it's $1.1 million maximum loan deductibility is going to drop to $750. That'll affect some of
it. And when does that start? Does that start this year?
Or the 1st. Actually, I think it started December 15th. So first or second home, mortgage deduction will be available up to $750,000.
But are you saying that HELOCs are not?
HELOCs are not, right. Now the
existing or new? Existing or new, or both?
Existing or new is what the code says.
Okay. So if you have an existing HELOC and it's a high one, it's limited to $750. Now, how does it work? Do you think if you have a
it's
$750?
Tom, I don't want to spend much time. We'll talk about it at your meetup. Right now, it's saying 0% interest starting in 2018 is what it's saying. So we've got to let them iron that out for us. The other good thing, a lot of conversation about state and local taxes. The solution was each person on their personal side can write off $10,000 of state tax, property tax, and sales tax. And I've looked at a lot of returns.
We got to hold that for after the break. So we have Richard Smith with us today, a 40-year accountant and investor, talking to us about the new tax law, and for which he will talk more at BayCom in a couple of weeks. So stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
I have with us Richard Smith today, 40-year investor and accountant, my accountant for almost that length of time for personal and my business. Who's also a real estate investor. So we're walking through the changes in the tax code. And by the way, if you are interested in more detail and want to get a set of handouts and slides and so forth, come to the January 25 Baycom meeting, the brand new one, Bay Area Commercial and Multifam meetup group, and go to tomwilsonproperties.com, and you will find a place that tells you what the location is and time and so forth. So that will be a Thursday evening, the fourth Thursday of January, and Richard will be there talking about tax, and Rick Knopf, expert in commercial real estate, will be there as well. Richard, let's talk about this corporate tax down to 21. So the hope and theory is that it will be able to bring a lot of corporate money back into the U.S., right?
Right.
What do you think? Do you think it's going to happen?
Well, they're going to give them a holiday. They're going to have a repatriation. Whatever you bring back, you get it at 10%, and that's a great idea. I mean, we really need to do that. I mean, here's Apple with $150 billion stuck in Ireland, so I think that's a great thing.
Yeah, I'm trying to think of how that wouldn't be good, and that's
I can't. I think it's all good.
Okay, yeah, that sounds wonderful. So let's talk about how this might affect people who have their own business. So what would be the reason if someone has a partnership or an S corp, LLCs? What would be the advantage of converting it to a C corp for individuals or small businesses?
Well, it really depends, Tom. I mean, that's complicated. We're talking to our clients right now about doing that. I mean, there's an overhead cost to be a corporation. You have to do a payroll for yourself, and there's a lot of overhead costs. I always tell my clients, if you're going to be incorporated, it's going to cost you $2,000, $2,500 just to be one. So you better get some benefit out of it. But most of our C corps, we want them to show zero income for the year. We don't want them to show a net profit because it's going to pay tax, and there's always the question about double taxation from a C corp. So most of our corporations are S corps, which are pass-throughs. They're passing through to the individual shareholders the net profit or net loss. Now, that pass-through is what we're dealing with in this 20% new deduction for certain income levels. This is really, really complicated. At your seminar, we're going to give them some examples of how that works. But it's not, it's not for this time and place, but it's something people should look into if they meet the income qualifications. Quite complicated. We're dealing with it right now and recommending to our clients, but there will be a lot of sole proprietors that may convert to corporations because there are some additional benefits that they don't get. But the sole proprietors also get the 20% extra deduction. So, that's a good thing for them. But, it depends on the individual situation, what you're prepared to manage in bookkeeping and accounting and tax returns. I mean, it's not a simple decision.
No, but at least whatever money you don't distribute the profits on a C corp now, at least the tax rate will be at a much lower rate.
Absolutely.
Yeah. So if someone's kind of on the fence which way to go, this might be enough to change that.
I agree. And there's other benefits. You get a medical reimbursement program, but again, if you have W-2 employees, that makes it quite a bit more complicated. But we can deal with all that stuff. If people can send me an email or give me a call. I'll be in Maui for 2 weeks, avoiding all the calls, but we can help them with that. And,
okay, we'll be back in a moment with more from Richard Smith. Stay with us here on Real Estate Radio Power Investing, talking about the new tax code and how it can affect you in ways that is a positive thing. Stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Richard Smith for Richard Smith Tax, Richard Smith & Associates, 40-year accountant and an investor. So, Richard, we're talking today about the changes in the tax code. What are they really now? Make sure whatever you're reading out there in the paper and so forth, make sure you've got one that's dated, currently, because there are a lot of different ones that try to keep up with all the changes, and a lot of those didn't stay. So make sure you get it current. Probably the best place to do it is to go to Richard at richardsmithtax.com, and also come to our Baycom meeting, our very first Bay Area commercial and multifam meetup group. We expect a large crowd. Make sure you get signed up. Go to TomWilsonProperties.com, and it's on the fourth Thursday of January 25 at 7 p.m., I'm pretty sure. And we're very excited about that. We're getting tremendous response. So Richard will be there to talk more and answer your questions and give handouts and so forth. Richard, let's talk about how personal deductions change. And I think you mentioned it briefly a little earlier, but let's tell them again what's this about, how the cap on personal taxes is affected.
Well, there was a lot of conversation. The way it ended up is a person is allowed to deduct $10,000. It's interesting, Tom. It's $10,000 single or $10,000 married. So some of my clients may be getting divorced to get $10,000 each. But that's the law, and it covers income tax to California. It covers property taxes, and it covers sales tax. Amazingly,
well, can't they just file separately?
No,
to get the 10K
very
each?
separate. You get 5 each.
Can't do that.
Be divorced. But that's just like 86. We had clients getting divorced for that law too. But this is for a lot of people. This works okay. 10K. And one thing I forgot to mention on the real estate that just came to me this morning, they maintained the $500,000, $250,000 exclusion on profits for sale of residence. They kept the law at 2 out of 5. Really interesting. You have to own it for 2 out of 5.
Everybody thought that was going to change, right?
Yeah, both the Senate and the House went to 5 out of 8. The Conference Committee went back to 2 out of 5. So who can keep up with that? Well, number two, the other one that's caused a lot of conversation are the dependents. Basically today, you get $4,150 for each member that you're claiming as yourself, your spouse, and your children. They've changed that. We've all lost our $4,150 deduction for each one of us that we're claiming on our tax return. But for children under 17, they're going to give you a dollar-for-dollar tax credit equal to $2,000 if they're under 17 and $500 if they're over. You actually are making money on this. So rather than a $4,100 deduction, which saves you about $1,000 of tax, you're going to get a $2,000 tax credit. So that's phenomenal.
So
I'm really, really excited about that. But you lost.
So, Rich, does that mean you're going to have more kids?
Yeah, right. Well, you know what happened, Tom? The one that bounced around with everybody, that's funny, was the alt-min tax. Originally, both the House eliminated, the Senate eliminated it. It's still in there, but watered down significantly. Because
what tax? I missed that.
Alt-min tax, they saved $750 billion of revenue over 10 years. And there were a lot of complaints about how much this bill was going to cost us. It was, $1.5 trillion. So alt-min is still in, but less harmful because no longer is there a California state deduction. It's limited to $10,000 along with your property taxes. So AMT, we don't think is going to be a problem. We haven't run much software on that, but those are all good things, and we're very happy for all of them.
Didn't AMT go away?
It did not go away. See, that's what I mean. Everybody
did
thought
not
that.
go away.
It did not go away. The House took it away. The Senate took it away. The Conference Committee at 2 a.m. Saturday morning put it back in.
Briefly tell our audience what the AMT is.
Alt-min tax is a second alternative method of determining what your tax liability is. It's really a flat tax at 28%. So in Silicon Valley, if you make over $250,000 in the past, or for this year included, you're paying AMT, as we call it. That's just the way it is. Now, under the new law starting in 18, you're more likely to be, if your income's less than $500,000, you will not pay it. So we're really, really excited about it. The AMT has been weakened and watered down. The other good law I forgot to mention, Tom, that's really, really good, the new deductions for depreciation we mentioned on real estate, guess what? Small businesses and corps got even a bigger deduction. They just get it 100%. Up to $1 million. So for new equipment purchases, that's so cool. We're really excited about it.
I meant to ask you that when we were back on the depreciation subject.
Yeah.
But,
well, that's not true for real estate, though. Real estate, the 20-year life rule for businesses, it's $1 million. So that's much better for small businesses. The other one that's kind of a negative, we're trying to work our way around it, is they've eliminated all of the itemized deductions under the miscellaneous category which is a tax prep fee. So all my clients prepaid me last year. And you can no longer write off your investment management fees, your IRA fees. You can't write off your outside salespeople expenses for using your car. So you're going to have to negotiate with your employer to pay you a little bit more. And they also have wiped out the alimony deduction, which a few clients have called us about. And we're putting together a 2-page list of all the things that have been eliminated. But I try to be positive and tell you the things that have helped people. Because the miscellaneous deduction, even though it did affect some people, I think that person who's a W-2 employee used in his car needs to have a conversation with his boss, because now the company's probably gotten benefit if they're incorporated. Now they need to share that with their outside salespeople. But there's lots and lots of other things, and we're glad to talk about whatever works for your clients. But I think it's a good law, and I think people are going to save more money than they realize. That's what we're seeing. And I think the higher income people, higher income being over 200, will benefit. But you're going to lose some things, and is that going to affect you dramatically? I just read one that I just read the state of California is considering the clients who lost this California state tax deduction about allowing us to take it as a donation to the state of California. Can you believe that rumor, Tom? That stopped me for a moment. I had to say that was very creative. I hadn't thought about that. So
that's pretty funny. And I have to admit that since a lot of clients prepaid you in December, I'm surprised you aren't in Maui already.
Well, I have to handle all these questions that we couldn't take care of.
Okay. Well, we appreciate you doing that. We'll be back after the break for a little summary here with Richard Smith, 40-year enrolled agent, accountant, and investor, talking to us about the new tax code, which is very important to know and how it affects you and how you can take advantage of it. Stay with us on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Robert Kiyosaki's advisor, Tom Wheelwright, whom I have the pleasure of knowing, is often says in his presentation something that people, it's a real paradigm shift in your thinking. We all kind of hate IRS and tax and so forth, never mind the fact that it's, pays a lot of benefits for the country. But he says, there's only 15 pages, like what is there, Richard, 6,000, 8,000 pages in the IRS tax code?
70.
Something like that.
70.
How many?
Go for it. Yeah.
7. Okay. So I think
and we just added 1,000.
Well, 15 pages of it tells what they're going to take from you for income. All the rest of it tells you all the ways that you can avoid being taxed, right? So if you have a good accountant and you have a good plan, you can minimize your taxes. And sometimes you can do some smart things that'll earn you more money staying in your pocket from that than busting your butt, trying to sell one more widget or one more property. But at any rate, Richard, thanks for being with us today. We will have Richard on as our opening speaker at our very first Bay Area commercial and multifam meetup group club, which is starting on January 25 at Santa Clara on Great America Parkway. It'll be 7 o'clock in the evening. There'll be refreshments, and we will also have Rick Knopf, who is a multi-decade real estate investor and broker for Colliers in the commercial arena, talking to us. So Richard, and go to TomWilsonProperties.com to sign up for this meetup group that's starting. And there will be a monthly meeting, by the way, and also sign up for our newsletter, TomWilsonProperties.com. That'll give you access to our commercial syndications, and it also will provide weekly information on what's going on in this world of real estate and the economy. So, Richard, sounds like overall you think it was a pretty good tax bill, and if we do the right strategies and get some good advice, we can take advantage of it.
I think good advice is critical now more than ever. There's one thing I wanted to share. By losing a lot of these itemized deductions, for your state of California tax and some of the others that you're losing, the government will allow you to take a standard deduction, a fixed standard deduction, $12,000 for single, $24,000 for individuals. For married individuals. We're finding that will help a lot of our clients. That's double what it used to be. So, we're trying to keep a positive vein on this, and you have to believe you can help yourself. But there's so many changes. It's just difficult to get your hands around it. But I think the meeting we're going to have, later this month, we'll have some handouts for you. But I think it will help more people than people realize. That's what I'm feeling right now. And I think people are going to be better off than they thought. And, of course, I think corporations are better off, of course. I think higher income individuals are better off. But I think, there are things we're looking at are the HELOCs. Can we put them against your rental? Can you put your HELOCs against your sole proprietorship business? We're working on fixing.
Richard, we got to wrap up here.
Okay,
Thank
you. What I have, Tom.
And we look forward to having you at our first BayCom meeting on January 25. And we will also talk in more detail about the new tax code. Thanks for being with us on Real Estate Radio Power Investing. Remember, the only thing that matters is what you do next.